Welcome to the Harry Sale Wealth Show, episode 9. Today's guest, I'm here with Rob On. He's the Associate Vice President of Wealth Planning and Tax Consulting here at Raymond James. Welcome to the show.
Thank you for inviting me, Harry. Yeah, great to be here.
I appreciate it. So let's just give everybody who's listening a background on what you do. So you obviously work with individual clients and business owners, specializing on tax planning, but just maybe give us a quick overview of your background and really what you focus on.
Right. So yeah, thank you for asking. So I spent over a decade in public practice. And that's how I started my career. I'm a CPA by training. So then I pivoted into a certified financial planner role. So starting around 2019, I've been doing full-time financial planning for business owner, high net worth clients, professionals.
I want to get right into it. A lot of people ask
Sure.
me the same kind of question, but they say, what's the biggest tax planning mistake that you would see Canadians making, especially around this time of year, like the beginning of the year?
Right. So the beginning of the year are times that we set goals and things. As an example, one of the ones some of you might be thinking is, how do I catch up on my RRSP? I have the first 60 days to make that contribution. So highly recommend do not wait until the last 2 weeks of February. Start thinking about that now. What's your contribution room? How much have you contributed last year? How much do you cash flow wise you have available to make those contributions? That will go on to your 2025 T1 filing, and that will generate some reduction on your taxes. And if you don't think about that, that could be a final rush and added stress that could be fairly easily avoided.
Yeah, we don't want that final rush. I've been working in branches before on the deadline, and it's a crazy day. And just for anybody here, I've also put a video together about RSP and TFSA decisions and what makes sense. We'll get more into that later in the video, but there's a video for you in the description. So just click that link and you get more information. So just touching on the RSP versus TFSA strategy, it's one of the biggest questions I get. Should I contribute to my RSP? Should I contribute to my TFSA? What makes the most sense? So if you're going through that decision tree with a client, maybe just walk us through why you might pick one over the other and how you sort of make that decision with your clients.
Yeah, there's a few factors. Everyone's differently. But what I encourage everyone is to find out what works for you, what your habits might be. For example, TFSA provides flexibility. You can withdraw it without tax consequences. However, you got to ask yourself, are you disciplined? So it's okay if you're not. That's okay. It's important to find that out. Now, if we talk about tax planning opportunities and things, you wanted to also look at your marginal tax bracket. So if you happen to be in a higher tax bracket, as in the next dollar that you earn, it's taxed at a higher percentage. So if you want to take the opportunity to make RSP contribution, the subsequent deductions, it's more powerful when you earn a higher income. So that's something to think about. But I find it's a good balance between the two where you consider, along with what are you going to do with the potential tax refund coming from the RSP deduction. If you wanted to spend it, then I highly recommend you look at an overall picture and go, this is the best use of this amount that you want to put away into your RSP or TFSA. So everybody's different, but I highly encourage just looking at all these factors in a holistic view on how does that amount best serve you for your own financial planning journey.
Yeah, we, just as you mentioned, we kind of take a look at what tax bracket you're in and if we can contribute you down to a different one. So you're paying a little bit less tax. So taking a look at the income tax bracket makes sense, the use of it. So it's not just a RSP, yes, TFSA, yes, it's a multifaceted answer. So I'm glad you touched on that. For RSP contribution room, calculating it and making sure that you've not over contributed are two huge factors that clients ask me. So number of people, when they start out, they really contribute to the TFSA for flexibility and growth. When they get to higher incomes, they shift over to RSP. So maybe just walk us through strategies about getting people up to their limits and then what their actual annual contributions might look like.
So what I would encourage people to read, I know many of us likely don't. I'm an accountant, so I read the notice of assessment coming from CRA. I know most of us just happy to get that refund and figure out what you want to do with that money. But when you file your tax return, you will get a notice of assessment. In it, there will be a page or a page and a half on RRSP contribution rule information on what your beginning balance was, how much that you contributed based on your qualifying income, how much additional RSP contribution room there was, and therefore how much you will have available that you can contribute from this 61st day of 2025 up until the 60th day this year. It's very important. You contribute to the RSP. It doesn't mean you have to deduct it in the year that you make that contribution. And the reason why I bring this up is if you happen to be in a lower income year, but you have that cash inflow you wanted to put into your RSP, you go, well, it doesn't really quite make as much sense to take that deduction this year just because it's a lower tax rate. You can make the contribution, and the amount of the contribution in the RSP account will start growing on a tax deferred basis. You can take that deduction in the following year or years when your tax rate is up. So growth wise, for that amount of capital, it starts as soon as that amount is inside the RSP account. Now you just gotta kind of think about when do you want to take that deduction.
Yeah, there's a number of things to unpack there. I know some people might think their limit is give or take 32,000. It's actually your accumulated RSP room, as you mentioned from your notice of assessment. So it's not just 32,000. It could be 100,000. It's depending on each person. And really interesting that you mentioned that you can smooth it over years. So I think some people think you contribute this year, you take the full deduction this year. You don't have to do that. One new account for Canadians is a first home savings account. And this is another angle where people will come to me and say, should I contribute to my RSP, TFSA, but now also the first home savings account, FHSA? When you're going through a decision tree with a client and they want to maybe purchase a house, what would you say in terms of the three accounts to target, or how would you work through that decision?
I would argue most of the practitioners will highly recommend FHSA as the first choice. And I'll tell you why. The contribution into FHSA is tax deductible, and they're tax free on the way out with the withdrawals. So it's really powerful. It's like RSP and TFSA decide to have a baby together. Sounds a little too good to be true, but it's available. Now, something to FHSA wanted to be cautious just because it's only hitting about 4 years old, so it started in 2023. You do need to open up an account for the accumulation or the contribution room to be available. So if you don't open out the account, you go, oh, it's 4 years in, 8,000 a year, I can contribute 32,000. Does not work like that. You open an account this year, or somebody nice enough to mention to you open an account last year, you get 8,000 or you get 16,000. Another thing to be mindful of is you cannot really catch up the entire 32,000, as I mentioned earlier, just because you say you're smart enough. I open up an account in 2023, never contributed any, and you gotta contribute now. You can only carry over 1 year contribution. So, for example, perhaps it's 16,000 instead of 32,000. However, if you're thinking about it, you can open up the account and you don't have to contribute yet. So I highly recommend it for those of us thinking about owning a home and things. FHSA, go and open up accounts so you can start having that room available.
So a lot to remember. We'll put this into a blog post really to how to decide between RSP, TFSA, and FHSA. Again, really what you want to do is if you're running into issues, you can check a video like this, check with your financial advisor, but there's a number of different rules that you should take into account. Penalties do apply if you do over-contribute or if you withdraw incorrectly. Always consult with a professional when you're trying to go through this strategy just to make sure you're maximizing every single dollar you've contributed. Now, we've kind of gone through the more personal side. So RSP, TFSA, FHSA for Canadians. Maybe let's shift over to business owners. I know a lot of people will go through their year end in November, December, January. So a lot of the business owners I talk to will go through their salary and dividend optimization planning for last year and this year. So for the incorporated business owners that you work with, I always get salary versus dividend. What should I do? How much should I take? For business owners thinking about that split in 2026 when it comes to tax planning, what kind of strategies or how do you talk through incorporated business owners' decisions when they say, how much salary should I take versus dividends?
I always go back to business owners' consideration on Canada Pension Plan and on RSP. For those of us who may be a little older, over 10 years ago, the tax rates on non-eligible dividend used to be a bit lower in certain provinces, so that there was a tax rate advantage to pay yourself $3,500 salary and the rest you do dividends as a business owner. And that landscape has shifted in the more recent years in terms of the tax rate. So the differential is quite marginal, quite small, so that tax rate wise, it doesn't make a huge difference. The consideration comes down to uh, unfortunately, Canada Pension Plan is quite expensive for business owners because you're paying the employer side on top of the employee side. So if you add out that 5.95%, you double that. That's close to 12% as a business owner that you have to go put that in. So some business owners don't quite like that, so they decide to go to the dividend route. Now, that's one consideration. Second consideration is CPP does build up a nice guaranteed income stream when you start taking that out. So that's important to clients like or audience like yourself. Some people appreciate having a higher percentage of guaranteed income, and CPP would be one income stream for that. And on that basis, I'm just coming back to saying if that's important to you, that your strategy working with your advisor and your accountant would have been at least take out the salary up to the CPP maximum pensionable earning. Now, beyond that level, you look at your RSP. How do you feel about RSP? There's folks who doesn't really like RSP, don't believe in RSP. I'm not advocating for either side. Most of the professional that you work with, most likely, I like to say, will recommend considering RSP just because of the tax deferred growth advantage, and also you get to have flexibility on the tax deductions from your RSP contributions. Beyond that, you do have that decision. If you want to do dividend, then you can decide to do so. So a few
Yeah.
factors to consider, but if you're going with tax rates as of the landscape that we're in, it doesn't make a huge difference as it once does.
Yeah, I do always say, I've heard a lot of people, especially, people who are savvy on social media will say, I don't want to pay any additional tax. I don't want to give the government more money like CPP contributions. The only, the biggest thing I can say back to that is it's one of the very few remaining defined benefit index to inflation with a
Yes.
survivor benefit pension that you can actually get. Very well funded. It is not just throwing money away. It's something that you need to consider. Another consideration here is if you're taking just salary or just dividends for that long, there will be a corporate bloat where you wind up with a later in life tax problem trying to get some money out of your corporation tax efficiently. This is a consideration for you every single year. I would not underestimate the power of taking some salary. So that's a huge consideration as well. One thing is that, for example, somebody who's working on a regular job has a regular paycheck and they have their steady T4 income. They know what they're going to have in terms of their RSP room. For business owners who don't take salary or have lumpy income, how does this affect their contribution strategy to their RSPs?
Again, advisor like Harry or also a tax accountant, like you heard me probably mention that 3-4 times already. This is not something you want to do yourself because we all appreciate how busy as a business owners might be. You may forget, and then you may become a last minute rush. But just be mindful. The new contribution rule is 18%, up to a certain limit, up to say 32,000. So you consider your you consider your cash flow. You look at that room available. You decide how much you're gonna contribute. You divide that by monthly or quarterly, depending on how you work your own cash flow for your household. And you just set out automatic contribution. So that way it's out of sight, out
Yeah.
of mind. And because you have done your homework, you have confirmed your contribution room, you do not worry about over contribution. You just need to ensure that you got that cash flow. And if cash flow may be a little bit of the concern, then you kind of go back to, well, set up a reminder for you right around the time you decide, you determine it's got to be a big cash flow inflow coming in. And remember, there's a phrase that we say, pay yourself first. So before you start spending and paying things, pay yourself first, save a little bit first, and then you decide what to do with the rest.
Yeah. That also bleeds into dollar cost averaging, making sure that you're invested on a regular basis. For us, it also increases discipline with your financial approach. You're not buying and selling in certain market conditions. So I think that's a very appropriate way to kind of look at it. One question I wanted to give a lot of time to before we sort of move into the more rapid fire questions, but a lot of business owners will say, I want to keep my money in my corporation because I don't pay as much tax on it. If I withdraw money, I pay tax. I want to keep it in there. Of course, corporate money, corporate investments are subject to tax every year when you earn income, dividends, capital gains when it's bought and sold. Relative to investing and taking money out in your RSPs and TFSAs, how do you walk through what makes sense for a business owner, whether to keep their money in their corporation or pay tax on withdrawal, but also get a benefit when they contribute to something like an RSP? And sort of how do you walk through that decision tree with business owners?
I'm an advocate for taking advantage of registered accounts to the extent they can, just because RSP is tax deferred growth. We're looking at decades of tax deferred growth, compound the power of compounding. TFSA, once it's inside TFSA, is tax-free growth, even better. Now, the amount that if you decide to keep your corporation, once you have utilized sufficient room of both register accounts to your comfort, is depending on the investment mix or the asset mix, any of the income component into your corporation, your investment account, or say you have a rental property, those are taxable every year. So you start to see a grind compared to a deferred growth. That amount, a year, 2 or 3, or even 5, you might not see a significant difference. But we're not planning a year before your retirement. We're looking at 10, 20, 30 years. That the fact it gets compounded, it gets really significant not to overlook. Once you have accumulated sufficient capital inside your corporation, earning passive income more than 50,000 a year, and you're still working, and you're thinking about your small business rate in the low 10% and things. Well, guess what? That's going to get affected. So for those of you fortunate that making net income for tax purposes more than $500,000, you will recall that it gets taxed at the general business rate in the high 20% range. I find a little bit older folks, our audience, you're just within 10 years of retirement, you've done really well for yourself, very successful, but you start to notice your tax rate for your business income start to get higher when your accountant explain to you. So that's also a good timing to come back to the drawing board and strategize and look at, okay, what are some opportunity and strategies that could implement or at least to consider.
I know that's a big consideration. A lot of business owners will say, I don't want to have money in there earning extra money, so don't invest it, because if I earn income in my account, I'm going to wind up paying a huge rate of tax. It's much more nuanced than that. So as Rob alluded to, there is a small business deduction, which we can go through together. But keep in mind, it does make sense to have some investments in your account, not just to only keep it there too. You always want to use an RSP and a TFSA in conjunction with your corporate account as well.
Right.
So let's move into a little bit more rapid fire. So number of things people ask me is, what should I be keeping in terms of documentation and record keeping? Maybe even jump ahead. I know when we do a contribution for you or any financial advisor does, we'll keep the records of those contributions. But to make somebody like yourself, if you were filing the taxes, to make your life easier, what would you want your clients to have in terms of documentation and record keeping?
Please, please, please avoid giving us a shoebox. In my early years as a young, new, fresh grad, I get handed a shoebox of receipts. I kind of reveal my age myself. We digitalize. So I find what's easiest or easier way is you take a picture, you digitalize the receipt and things, where if they're digitalized to begin with, you do that right away. You file that right away. So you could decide to use an app, upload it right away. You get in a habit of doing that right away every time, like regularly, then You don't minimize having to carve out an entire morning or entire weekend day when you can spend time with your family. Then you have to say, oh, I had to kind of go collect and go that.
Yeah.
And the other thing is, I find best practice is you do that right away. Also reduce the chances of missing information.
Love that. I just take care of it every single time. As soon as you get a receipt, take a picture of it and file it away. Common tax planning mistakes. So what's the most expensive or painful mistake you see clients make on a regular basis? And then, of course, how can they avoid doing that next time?
Planning takes place before events happen. So if you come back and go, oh, this happened, what can we do about it now? It's very expensive to try to fix it if it's even fixable. So I will highly recommend two things. One is if you're thinking about something, you think maybe tax implication, well, talk to your advisor, talk to your accountant and say, hey, I have this in mind. I'm going to run that by you. Do not go out and do that thing already and then come back and tell us. So sometimes we might not be able to do anything to help you. The other thing is thinking about a timeline. As an example, there are things we mentioned earlier that I could do in the beginning of the year, getting ready for the tax season. There are also things that you wanted to think about before the holiday break, say in November, and things. Some of you may have heard of tax loss harvesting, things to incur some losses even on your income. Well, those kind of things, you can't really do it in January every year for the prior year. And you certainly don't want to do it during around Christmas time. So you kind of start out towards the end of the year. And also for the business owners, for example, November, perhaps even December is kind of the time that if you have opportunity to chat with your accountant, decide how much taxable income you want for the year. Kind of go back to our salary dividend question earlier.
Love that response. A lot of people will say to me, I can do this myself. I've always filed on my own. When should someone consider working with a tax professional versus doing it themselves?
Some people really like to do it themselves. If you find it a bit challenging, or if you find it you are spending more time than you have set out in place, those are all indicators, or perhaps it may be worth just pay to get that problem away. And the other thing is just ask around in your circle and just think, because the most professional, we try to be helpful. So we can also help you determine and go, well, within what you're doing in terms of your tax filing, there's certain aspects, there's complexities to it. The challenge with the way how our tax system works is that even if you make a mistake and you do have it assessed, it doesn't mean it's error-free. There is a period of time that 6-7 years you do need to keep your records.
So not necessarily every year, but maybe if there's increased complexity for a year, just get it done by a professional, keep your records 6-7 years. So someone listening to this in early 2026, what would you say from this entire conversation and your best advice would be the top 3 things that people should do right now for their tax and financial planning?
Top 3 things, some of those we mentioned earlier. Look at your RSP. If you got contribution and you wanted to take advantage on your 2025 T1, now is really time to look at. Do not wait for another week or two. You're going into the RSP season. Take a look at that right away. If you've done that, good for you. Have you done that $7,000 of TFSA contribution for the new room available? Because once the amount is in, as we talked about earlier, in whichever registered account, your tax defer where your tax-free growth starts. So that's something that you want right away. If you got that cash flow, don't wait. Put that in, or your dollar cost averaging, do the automatic saving. And third, what I highly recommend, this is early in every year, this time of the year, it's a good time to kind of look at your cash flow, your budgets and things. Very high level check. Anything changes, take a look. And some of the fun things along the way, looking at a budget is the fun part is, yeah, you might want to start thinking about where you want to travel this year.
It's huge. It's really important to have that proactive nature about this. It definitely helps when somebody contacts you and I about it, so they have their ducks in a row. That really brings us to the end, Rob. I really do appreciate your time. And if you do want to talk to somebody like Rob or myself, our contact information will be in the description below. And Rob, thank you very much for joining us today. I really do appreciate it.
Thank you for having me.